Good evening, everybody. Welcome to the slightly late starting market strategy session for June 14th, 2015. I am your host tonight, Michael Tiny Saul. Paul will be along shortly, but for now, I'm running the show here, so I'll start to talk about the upcoming economic reports that are due out. First, on Monday, Draghi speaks at 9. That's pre-market. Then we have the 9:15 capacity utilization industrial production and the housing market index at 10. Now, the European Court of Justice ruling, that's something to watch. I don't know what effect it'll have on the U.S. market. There's also ZW economic sentiment, but building permits come pre-market for the U.S. The FOMC meeting is Wednesday. Okay, and for those of you in the Mastering Market Timing or the Inner Circle, we're going to be talking about a specific trend that plays into that announcement. Okay, now overall, the best kept secret, the worst kept secret that has to do with the FOMC meetings is that we are usually bullish into them. So keep that in mind. That's just kind of a sentiment kind of deal. It's not something you can really put your hooks in, but it's definitely something to pay attention to. Thursday, CPI, core CPI unemployment claims, and the Philly Fed manufacturing index. More than likely, they will not raise rates on Wednesday, is my guess. Now, Paul may say something different. I don't think they're gonna. I think they're just going to use some of that scary talk that they're going to be raising rates. But we'll see. There is a press conference this time around that starts at 2:30. Let's take a look at the market. So the market is in yet another coil. Now, this coil is different than the coil that led into this breakout in May because this is happening after the breakout has already, I don't like to use the word failed here. I think failed is a poor choice of words because all it really did was go back into the range. So failure is kind of a different kind of a weird term to use. Failure to me would be we broke out and then we went out the bottom of this thing, which can happen. Okay, it doesn't have to happen in a day or two. I mean, that's a pretty large range, but I don't really consider the breakout to have quote unquote failed. So far, it hasn't worked. Now, last week we came down into support. We formed a doji, and from there we did get a nice bounce on Wednesday and Thursday, but we were already running out of steam. Now, in the Inner Circle video, I gave my very crude Elliott wave count. It's really, I don't know how on target it is. I'm really not a great Elliott wave theorist. Okay, I am a fan of Ralph Elliott. I do feel that he has a lot of good things. He taught a lot of good things. He's passed away now, long since passed away now, but and I do like the motive in 5, corrective in 3 kind of deal, and I do like that. I'm just not a to the numbers counting out all the waves, and and probably because I'm not smart enough to do it, and I mean, maybe that's self-deprecating. Was that the word? Maybe I'm not even smart enough to say that right. But it did take me a long time to understand Elliott wave, and I am nowhere near good enough to be able to just put counts on any single chart. I'm just not good enough to do that. And I don't care. I'm not one to run from my weaknesses, to be honest. I would rather work on my strengths. And look, I gave Elliott wave the good old college try. It didn't work for me. So now I tend to, I try to read people who are experts in it. Of course, most of the self-proclaimed experts have been way wrong for many years including the biggest name in the bunch, calling this entire rally completely corrective, which makes absolutely no sense to me. But that being said, to me, it looks like we can continue to trade down a little bit further. All right, we have this low right here, and there are some timing signals that suggest this low does get taken out. And then, of course, we have some more measured moves in here. Then we have the 200-day moving average comes after the measured moves. This, by the way, was a measured move besides being a 78.6% retracement. We have a couple more measured moves, and then we have the 200-day moving average, and then the bottom of this range. So there's a lot of hurdles to still get through. I am nowhere near ready to call a top. I am nowhere near ready to say the high is in. And the main reason for that is the financials are acting very nicely. And it's tough to call a top with the banks and brokers. And now insurance, which is KIE, joining. So all three of the sectors inside the financial group, okay, or all three groups inside the financial sector, however you want to use the term, are now in sync here. Even the XLF is starting to rock and roll a little bit here. But if you look at the banks here, you have a nice small little bull flag right here. If you look at the brokers right here, you have a not as nice, but it's still okay. It's still up above the moving averages. And now you have insurance, which is the third prong of the financial group. And now they're all looking pretty nice. Not really, not what you really want to start a bear market from. Sorry, I don't really believe a bear market has started with this. I mean, maybe I could be wrong, but I'm not really, I've looked at a lot of bear markets, and I have yet to see one that the banks were hitting new relative highs and kicking butt, and we just decided to go into a bear market. I just haven't seen that. So I am not ready to call a top like so many people are so quick to do. That being said, that doesn't mean that there may not be the opportunity for some short side trading. All right, just because it's not a bear market doesn't mean that you can't take some opportunistic shorts. Now, Lee asked a great question: do the banks always lead for these three? No, they don't. And the question that you probably should be asking is, do they have to lead for these three? I have seen the brokers lead. I have seen insurance lead. I have not seen the banks lead all the time. But the bigger question is, do the banks have to lead in order for it to be a strong market? So, for example, when we talk about the major indexes, you'll oftentimes hear me say, I want to see the NASDAQ and the Russell lead. Okay, and in this case, the Russell is leading out of the majors, which is good. Okay, but I want to see the NASDAQ and the Russell lead. In a pinch, I'll take the S&P 500. What I don't want to see leading is the Dow. The Dow is what I call a media index. It's great to quote big numbers. It's great to say how many points we gained or lost, all that, but I don't believe that the 30 stocks in the Dow Jones Industrial Average is good enough to say, hey, you know what? This is a good representation of what the market is doing, okay, based on these 30 industrial stocks. I just don't believe it, right? Now, you could go bigger than the S&P 500. You can go to the Wilshire and all this stuff, or the Wilshire, whatever it's called. Wilshire, I think, is a street in California. But you go to the Wilshire 5000 or whatever. I don't use it, so I don't care, right? And that's kind of my, for a lot of years of trading, I used to have to know everything. Now I don't care. Okay, I just don't. If it doesn't affect me, I don't care about it. So, the S&P 500 is the absolute benchmark. Okay, and therefore, when you tell me broad market, I tell you S&P 500. Okay, So that's just, something that what and Paul is the same way. I mean, he'll look at the New York Stock Exchange too, but looking at the 5,000 stock, look, it's broad enough, right? So now, so taking that, Lee, into banks, brokers, and insurance, I will say that from what I understand, and I'd like to ask Paul this when he comes on, it'll be the first question I ask him, but you would like to see the banks/brokers lead. You would one of them in first, and insurance can bring up the rear. But he may say it doesn't matter. To me, I don't really, unless there's such a big divergence, like one of them is so far ahead, and like last week you saw the insurance group lagging. It was kind of a problem, but you had 2 out of 3 that were acting well, the brokers and the banks. So it's kind of tough to say, yeah, the financials are in trouble because insurance isn't rallying, if you know what I mean. So it's kind of how I will look at it. Now the Russell, I was trying to pull up Met. So now the Russell, right? So here's MetLife, which is a nice little breakout. The Russell is showing good relative strength, and that's a good sign. All right, but you can't get around the S&P 500, which I already showed you, and the NASDAQ, which are, they're hanging on to their 50-day moving averages, which is the intermediate term benchmark moving average. Okay, why do I use the 50-day? Well, William O'Neill is big on it. He talks about it in Investor Business Daily. A lot of people use it, and therefore it's something that we need to be aware of. Okay, there's a very big saying that if you want to make money, basically anything, right, you do the opposite of what the herd is doing. Okay, so in other words, right, what do they tell you? They tell you to buy on weakness, sell on strength. Of course, right? That's what you're supposed to do all the time. And it's very tough to buy on weakness, very tough to sell on strength, because you always think it's going to go down further, or you always think it's going to go up further, right? But just because you should do the opposite of just because you do the opposite of you should do the opposite of what everybody does, or that's at least how the saying goes. In order to do that, what do you need to know? You still need to know what everybody else is looking at. So I always want to know where we are to the 200-day, where we are to the 50-day. What are we doing? What's coming up? And it's very important because we want to know what the crowd is doing, what the herd is doing, and we either want to fade it, or if there is a way to piggyback it, or more importantly, front run it, that's what we're looking to do. Okay. Why use SPY instead of SPX as U.S. economy is the lead? For example, SPY does not mirror S&P, and while SPY shows new high after S&P, will SPY follow? I don't understand what you mean. I think the SPY and the S&P 500 move pretty in pretty good tandem here. So, I mean, I could use the SPX. The reason I don't use the SPX, because I can't spell it. No, the reason I don't use the SPX is I don't like the gaps. I'm not a big fan of the gaps that don't take place on the SPX, right? So here's the SPY, and here is the SPX. I don't know. To me, it looks like they move pretty well together. I don't know. Does anybody disagree besides the good doctor? Which is fine. It's okay to disagree. I disagree with almost everybody on a daily basis about something. And I can't shrink this, which I'm pretty upset about here. I don't know. I mean, it looks like it follows it pretty well to me. Right? What am I missing here? And I definitely think it's good enough to do the setups on, but you could use the SPX. There's nothing against it. It doesn't look exactly, but to me, the SPY actually trades. So the SPX only trades with options. You can't trade the SPX. You could trade the SPY. So yeah, there'll be discrepancies, but again, there's no gap, right? So like there's the gap on the SPY. There's no gap on the SPX. I don't know. That's just me. So the mid caps are just chilling. They're in a sideways consolidation. They have been for a while. I mean, that's bullish. They're over the moving averages. That's good. Here's the diamonds. They're bringing up the rear. They're acting the craptastic. They tested the April lows, and now if they break down here, you got to watch this 200-day. Again, I don't use the diamonds or the Dow. If you want to use Indu, it's fine. Right? I don't use it as a leading index, so I'm not really that concerned. Okay. Let's look at some sectors. You got IGV. It looks great. I mean, this is the software. Still looks great. Still hanging tough. Look at some stocks like Adobe. Yeah, I mean, just really acting well. Like big softy, the big softy, Mr. Softy, trying to wedge up here. All right. How about the socks? We can use the socks. We can use IGV, but we'll use the socks. The socks had a problem. The socks broke out and gave it all back. That to me is definitely a problem. And it's not a problem saying, okay, now it's at the top is in and we're in a bear market, but it's in a problem being that when you can't hold your mud, when you break it out like that, right? So, that means that there's more work to do before there can be a stronger push higher. So you want to watch that with the socks. SMH, similar, right? Biotech is interesting. Biotech is still hanging tough. I think Paul's still long it, but I don't let me speak for his positions. But Paul, I know Paul likes the IBB. I think he's again. I don't want to speak for him. So there's like the BTK, and then here's the IBB. It's still acting fine. Okay. Banks, we looked at XBD. We'll look at again. All right. How about housing? Yeah. I mean, home builders. I mean, this isn't, somebody asked me if this is a cup and handle. No, I wouldn't say this was a cup and handle. It's a good, I mean, it's not the worst thing I've ever heard, but it doesn't look like. It looks more like this kind of triangle. Right, and I mean, maybe it can break out of here, or maybe it wants to fill in a little bit more. But yeah, the home builders, I mean, they look like, again, just one more sector, one more index that is consolidating, and that's fine. You can't fight it. It's like it becomes monotonous. It becomes monotonous for me too to look at the charts every day and go, oh, here we are, we're in a sideways consolidation. Here we are, and yet, what am I going to do? Call up the market, and I wish I had their number, and scream at them, move. I mean, I don't know what to do with it. Just got to wait. I mean, I do know what to do with it. Just got to wait. Wait for it to tip its hand. Junk bonds, which is one of Paul's favorite things. These are high yield bonds. Paul loves to look at high yield as a market timing signal. And you could see here, it's in a consolidation, so it can go either way, but based on the way we broke down here, this is the momentum push. It looks like we have more to go on the downside. So that's not going to be good for the bullish case. Again, the bank's rallying, not good for the bearish case. What does that tell you? Hey, a coil sounds about right. Okay, if you're going to get, if you're going to get people pushing and pulling on both sides, or it's a tug of war, well, then the market should be in a consolidation. Okay, and that doesn't mean that, oh, all right, you can't trade it. You just got to wait. You just got to find the stocks or the ETFs or the futures, whatever you're trading, that are in setups. And there are, they're out there. Just got to mine for them. You got to look for them. Okay. What else? Let's look at bonds. So bonds had a nice wicked day up on Wednesday, and then Thursday they had, on Thursday, and then Friday they had the push up and failed right below the 20 EMA. Now they're up 25. It says they're up 25, 30 seconds here. Wow, so it looks like they're rallying a little bit here. So what the S&P's doing? Yeah, the S&P's down. Gold has come up and kissed this channel that it broke. Looks like it kissed it goodbye. So now what we have to do is we have to wait and see, are we going to fall from here? And if we do, we should go back to those November lows. I think gold is going lower. I still think gold is going lower. The miners broke, and they look like they're going lower here. All right. To me, gold looks lower. Silver looks lower as well. All right. Silver a little bit, holding up a little bit better than gold, but not by much. Crude oil, I mean, you have to look at it, but you don't have to act on it. Now, this is a pretty good seasonal time for crude oil. Usually crude oil rallies here into the July 4th time frame. That is the peak of that is supposedly the peak of driving season. Okay? So that's what you want to look for here. See if it gets a late breakout into the July 4th time zone where it should top out. Now, it doesn't have to top out July 4th. It could top out after, it could top out before. It may never top out because it may not get there. In my opinion, oil is going lower on the longer term. This break does not just get retaken, in my opinion. I still think we have lower prices to go. We did come off a divergence here, but I think once this divergence has ended, I think we're going to roll over. Okay. Let's look at some of the grains. Yeah, I mean, corn, wheat, soybeans all look like they want to go lower. Sugar and coffee and cocoa. Let's look at cocoa. Cocoa looks okay. Looks strong in the softs. But sugar, no. Looks lower. Coffee, yeah, still looks lower. These still look lower. These still look like any lifts are getting leaned into or getting sold into. Okay? So that's what you want to pay attention to if you're trading these. I don't know if anybody here trade commodities or just stocks. And I mean, I'm sure we get some ETFs. I'm sure we get some futures traders too. But anybody trade these like the commodities? Okay. Okay. Now Greece. Oh no, Greece. Greece again. No, Greece. Greece. Okay. So as Paul and I have been saying now for what seems to be 15 years, but it's really a lot less than that. Really, what is it, a year and a half or whatever this, that Greece will be yet another non-event. Just all hype. All right. And the euro is coiled. Okay. Here it is. It's coiled up. How about the yen? So the yen is interesting. The yen broke out, consolidated, went a little farther, and is now pulling back a little bit here. So you got to watch this here. But if it holds the support, should offer an opportunity for a buying opportunity for a buy zone if it holds that breakout point. Dollar Canadian dollar, Canuck dollar, Canadian dollar, or the Canuck buck. All right, you got a lower high in here, and now it's just kind of consolidating around. I'm not even going to call this a coil. It's too sloppy. Too sloppy. Yeah, the Looney Tunes, that's right. So, I mean, that's really it. Looks like Paul ain't going to make it because I'm done. Really not much more to talk about. We got the FOMC coming up. There is usually bullish bias into the FOMC, but that is a seasonal bias, seasonality, whatever you want to call it, the seasonals. In my opinion, the technical pattern always will override these, and the S&P 500, the NASDAQ, the Dow, they look like they are ready to make a short-term move. While the Russell and the mid-caps are outperforming, and maybe that's the clue that's right in front of our face that we're going to miss. Oh, well, this should have been obvious. The Russell was leading. Okay. I feel that we have lower prices to be seen, but I am giving the benefit of the doubt to the pattern always. I want to see which way this pattern can break from. Paul may have stronger opinions on that, and we'll be updating that into the Inner Circle members if we do break and hit new highs. I know last week he said he would be selling into new highs, but that can change from week to week. That's why it's trading, not why we have these every week and why we do video updates every day for the Inner Circle folks, because things change. And even though now it looks like a boring market with a lot of overlapping candles and we're not doing much, and we could last like this for a while longer, eventually we're going to get nice, crisp directional moves. And when that happens, okay, that's where you got to make, you got to make the hay when the sun shines, right? It's the 20-80 rule, 80-20 rule, the 15-85 rule, the 10-90 rule, which is the market will consolidate for 80% of the time and move in a trending direction for 20% of the time. And that can even go down to 90-10 for spots. I mean, you could see it here. It's months at a time where this isn't directional. This is more consolidating. Then we get a burst of directional movement, and then we go sideways again, and then we get directional movement, and then we V up, and then boom. Okay, so the Swiss franc, let me look at that for you. So you're looking dollar versus Swissy, or do you want the Swissy versus dollar? Or do you want the ETF? You got to give me exactly what you want, because these are reversed, right? Because if I use the cash, it's going to be dollar versus Swiss franc. But if I use the future, it's the Swiss franc versus the US dollar. I like saying franc. Well, it does matter because you're asking me if it's going to run up, right? So, like, what are you trading? Tell me what you're trading. So, are you asking me? You know what I mean. So, you ask me, is the Swiss franc going to run up against the dollar? Is that what you mean? Okay. So get strong against the dollar. I mean, right now, as you can see by the futures contract right here, and this is the Swiss franc versus the dollar. This is how the futures work, right? It's the inverse of the the cash, it does look like, once again, it's coiled up. But I mean, you could see this. This is a beautiful, beautiful pattern here. And when this breaks, yeah, I mean, this has the potential to really be a nice push out here. Now, I don't know if it's going to be because of grease. I don't, I do know that the technical pattern suggests that, I mean, if gun to my head, which I don't like to do, I don't like to trade gun to my head, but we are over the moving averages and we are in a coil. So yeah, it would suggest a lean to the upside here. But the coil has to really be the most important thing. And you have to be careful not to get completely overly biased because the coil could absolutely break down. But if you were to ask me, you got to pick a side, I would say it's going up. Luckily, I don't have to, right? That's my 5-year-old going in the shower, so it's always a circus for them going in the shower. Anyway, thanks for joining me. See you next week. Paul should be back, and I will talk to you. Next week, next Sunday, 8 p.m. Eastern. All right, everyone. In a circle, folks. If you have any questions, just write me. Take care.